If you own cryptocurrency, stop scrolling for a second. Because what I'm about to explain could affect you sooner than you think. For years, people talked about crypto like it was the Wild West. Unregulated. Private. Invisible. A lot of Americans believed that if their crypto wasn't tied to a bank account, the government couldn't see it. No paper trail. No problem. That belief is now falling apart. And it's happening because of one form most people have never heard of. Form 1099-DA. Welcome back to LegalLoopholeUS. I'm Mike. Today, we're breaking down what happens when your crypto wallet, the IRS, and the US court system collide. No hype. No scare tactics. Just how the law actually works right now. This is not legal advice. This is real-world education based on federal tax law and current enforcement trends. Let's start with the biggest misunderstanding. In the United States, the IRS does not treat crypto like cash. Bitcoin is not viewed like dollars. Ethereum is not viewed like money in your wallet. Under US law, cryptocurrency is treated as property. That matters a lot. If you buy a house and sell it for more than you paid, you owe taxes. If you flip a classic car for a profit, you owe taxes. Crypto is treated the same way. Stocks. Real estate. Digital assets. Same idea. Because of that, 3 actions can create a tax bill. First, selling crypto for US dollars. That one is obvious. Second, trading one coin for another. This is where many people mess up. If you swap Bitcoin for Ethereum, the IRS treats that like you sold Bitcoin first. That trade can be taxable. Third, using crypto to buy something. A phone. A laptop. Even a cup of coffee. You may never cash out to your bank, but the moment you use or move the asset, the tax obligation starts. Now here's the question people always ask. How would the IRS even know? For a long time, the IRS relied on honesty. They added a simple yes or no question to your tax return asking if you used digital assets. And a lot of people checked no. So the IRS changed tactics. Instead of asking, they went to court. They used something called a John Doe summons to force major crypto exchanges to turn over user data. Names. Addresses. Transaction histories. Wallet identifiers. Federal judges approved it. That was the moment crypto privacy hit a legal wall. But collecting all that data by hand was slow. So the IRS did what the government always does. They automated it. That's where Form 1099-DA comes in. This form is designed specifically for digital assets. Crypto brokers and exchanges will be required to send it out. 1 copy goes to you. 1 copy goes straight to the IRS. Just like a W-2 from your employer. Just like a 1099 from a stockbroker. This is the shift. Before, the IRS had to look for problems. Now their computers will flag them automatically. Here's a real-life example. Let's say you actively trade crypto throughout the year. You make dozens, maybe hundreds, of swaps. Some small. Some bigger. Tax season comes. You do your best. But you miss a few transactions. You file your return and move on. 2 years later, a letter shows up in your mailbox. The IRS received a 1099-DA showing more activity than what you reported. Now you're not just dealing with unpaid tax. You're dealing with interest, penalties, and questions about whether the mistake was intentional. That's how routine audits turn into legal fights. This is where lawsuits start to appear. We're already seeing cases in US tax court where people are challenging how crypto income is calculated. One well-known dispute involved staking rewards. Taxpayers argued they shouldn't owe tax until they actually sell those rewards. The IRS refunded the money instead of letting a judge set a binding rule. That tells you something important. The law is still evolving. But while lawyers argue policy, the IRS enforces first. And when the rules are unclear, the government usually takes the position that benefits the government. Another mistake people make is ignoring losses. Some folks think, I lost money this year, so none of this matters. That can backfire. Reporting losses can actually reduce your tax bill by offsetting other income. But if the IRS sees a 1099 DA showing heavy trading and your tax return shows nothing, they don't see losses. They see unreported activity. And in the eyes of the law, silence often looks suspicious. Here's the bottom line. The invisible era of crypto is over. The data is there. The enforcement is here. And Form 1099 DA is how the IRS connects the dots. Most people who end up in trouble aren't criminals. They're regular Americans who didn't keep records, or didn't realize that a simple coin swap counted as a taxable event. But in court, I didn't know rarely wins. Education is your best defense. Understanding how crypto is taxed gives you the ability to plan, document, and stay out of trouble before it starts. If you want to stay ahead of these legal shifts in the US, make sure you stay with LegalLoopholeUS. We break down complex rules into plain English, so you can protect what you've built. No hype. No fear. Just the law. I'm Mike. Thanks for watching. And I'll see you in the next video.